Hey guys and gals, Kevin Bupp here. I've got some very exciting news I'd like to share with you before we jump into today's show. Now, after closing on Fund 4's first acquisition of a $50 million institutional grade mobile home park, we're adding a second irreplaceable piece of real estate to the portfolio, and it's coming into the fund with over $1.5 million of built-in equity for our investors day one. Now, when I say irreplaceable, I really do mean it. I mean, this is an affordable yet high-end waterfront mobile home park located in the Columbus, Ohio market. Quite literally, every single mobile home on this property is right on the lake, each with its very own personal boat dock, meaning a very high demand for affordable weekend getaway options, as well as year-round housing for working Americans. This is a true unicorn of a property, and you will not see another one like this come around again. It really is a one of a kind. A few other aspects worth noting. This park is producing stable and predictable cash flow day one. We're acquiring it with an excellent in-place Freddie Mac loan at a 3.3% interest rate for the next 8.5 years. This also includes a period of interest-only payments. Again, the simple supply and demand dynamics here are enough to get excited about. This is affordable lakefront real estate for both the working American families as well as folks looking to lock down a reasonably priced waterfront escape. Don't let this opportunity pass you by. Visit investwithsunrise.com to register for our webinar and learn about all the wonderful aspects of this property going into Fund 4. Again, that's investwithsunrise.com. Now, let's get on to the show. Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert Jeff Gleiberman. Now, Jeff is the president of MG Properties, a vertically integrated multifamily firm with over 28,000 units and recognized by NMHC as a top 50 apartment operator. Now, Jeff is responsible for overseeing investment transactions, operational strategies, and partner relations. Jeff's unique experience has allowed him to drive substantial platform growth while staying true to his firm's founding principles. Now, prior to MG, Jeff worked in an apartment investment sales at CBRE, where he oversaw the sale of $500 million in Southern California multifamily properties. Now, Jeff has a business degree with an emphasis in finance and management from the University of Southern California and a Master of Science degree in real estate. And so, guys, with that, it's an honor to welcome Jeff to the show. Jeff, how you doing today?
Doing great, Kevin. Thank you for having me.
Excited to have you here. Excited to learn more about you and MG and everything that you guys have going on. I know it's a family company. It's been around for a number of decades now, so you guys have quite the experience. You've gone through a number of investment cycles, and so excited to maybe peel back the curtain and learn a little bit more. Before we go into the nitty gritty of it, just for those that aren't familiar with you, Jeff, your story, your company, MG Properties, just maybe take a few minutes, fill in the blanks from that introduction I provided you, and tell us a little bit more about yourself.
Sounds great, Kevin, and I'm very happy to be here and share our story and talk a little bit about what we do. We are a vertically integrated investment firm that focuses 100% on existing multifamily investments. So we don't do any ground-up development. Everything has been stabilized properties. And the business was founded by my father, Mark, in 1992. He was a tax accountant in the 80s, saw lots of tax advantages to real estate, lots of wealth potential. And so we started putting together syndications, partnerships with friends and families in the 90s. We're from San Diego, and the first 50 deals were all in San Diego until 2000. And we started expanding to new markets all over California, into Oregon, Washington, Arizona, Nevada, and Colorado. So over the last 33 years, we have expanded into 6 states, and the current portfolio today is right around 29,000 units. We have just over 100 properties and been through many cycles, as you mentioned, seen a lot of changes in the industry, and very excited about some of the opportunities we're buying right now. We've been very active the last decade and the last couple of years, so really happy to discuss anything that would be helpful.
Yeah, no, I appreciate that, and excited to see where the conversation goes here today. I guess backing up to a comment you made, just it caught my attention, so might as well get it out of the way here in the beginning. You mentioned you only look at purchasing existing properties, no ground up development. Just curious as to kind of the thoughts behind that and why you've never, I guess, ventured down the other path.
Yeah, we are really disciplined to a fault, and we have done the exact same thing over 200 times now. So there's a
Hmm.
different risk profile with development, as everyone knows, and it's not one that we're really willing to take or risk. On the over 200 deals that we have done, we have never had any losses. Every deal's had a positive return. And when you start venturing into some developments, you really have a lot of timing issues with the cycles. And
Hmm.
since real estate is so cyclical, we are long-term holders. We plan to hold deals for 10 years, and we can make it through any cycle as long as we're picking well-located properties that are well-built. And we do, as I mentioned, we are vertically integrated. So we do everything in-house. We have in-house
Hmm.
property management, asset management, construction management. We've got 930 total employees, with 130 in the corporate office here in San Diego.
Fantastic. No, I appreciate that. And just you guys were based in California, start buying in California. Obviously, you've heard the various sentiments out there about folks leaving the state of California. It's not all that landlord friendly. It's a lot of times more geared towards tenants. At least when you compare it to maybe other more conservative states, Florida being one that I'm based in, very friendly to landlords here. And so I guess just while I guess a lot of folks, and I shouldn't say a lot of folks, but just generally speaking, it seems as though the sentiment would be that a lot of investment groups are somewhat bearish on California real estate, whereas I feel like your view is somewhat opposing. I mean, you guys have a lot of holdings there. You've got a lot of experience in that state, and it seems as though you continually buy in California. Just curious as to kind of where the niche expertise lies and why you guys are still very excited about the California real estate market.
Yeah, no, it's a really good question. And there's definitely different risk profiles in every
Hmm.
market and geography. And one of the reasons that we have the diversification of 6 different states is so we don't have to just look in California, but we still believe there is a lot of opportunity in California. We started here, we know it well, it's our
Hmm.
backyard. It's very resident friendly, and that also makes it harder to develop too. So it has some of the best
Hmm.
fundamentals in the country for new development to population and to job growth, where it's very hard to develop. It takes a long time. It's very expensive. So we still want to have our bets in different parts of California, and we're very sub-market driven. So every year we try to purchase um, at least a deal in each one of our markets. It doesn't always happen, but we focus on sub-markets that don't have a lot of new development. They have easy access to jobs and a lot of other kind of check marks that we've made along the way. So on an average year, we're purchasing between $1 and $2 billion of acquisitions, which is about 10 to 15 different deals. And that will comprise some in California and some in the other states that we operate in as well.
Got it. Understood. Appreciate that. And how about just the navigating when we speak to just the tenant landlord side of things, I guess more as it relates to rent control. And I California, correct me if I'm right, it does not have statewide rent control. It's more municipality by municipality. Is that correct, or is that
No,
inaccurate?
we do. No, we do have statewide
It
rent
is.
control.
Okay. I didn't I
Yeah,
didn't know that. Okay. How
yeah.
about
No, so many of the coastal states do
mhm,
over here on the West Coast. So Washington, Oregon, and California. It's pretty minor the way that it's written right now. It's not. It doesn't
mhm.
affect us very much. And if we're hitting those limits, then we're beating our pro formas, and usually we're pretty happy.
Got
But
it.
it doesn't mean that it can't change one day to become more strict or be more, restrictive on us. So there's
Hmm.
definitely a political risk on some of these states that we're in. That's different than Florida, where you are, which, we don't monitor too closely, but it would be
Sure.
different than Arizona or Nevada or Colorado, where we also own.
No, no, fair enough. All good points. So, would love to get a better understanding of you guys have been at this now quite a number of years. We've gone through some market volatility over the past year and a half, 2 years, and just curious as to how you guys have navigated these somewhat precarious times. And have you made any major, I think more specifically, have you made any major pivots or structural changes inside the business to adapt?
Yeah, there's, having the vertically integrated platform really allows you to adapt quickly.
Hmm.
And we're always trying to stay on top of all the new technologies and really just manage our properties the best. But about 75% of our business is high net worth syndications with our private investor group, and 25% is with institutional capital for some bigger deals and some deals that have some different metrics. But on the private deals, we do long-term fixed rate financing, either 7 to 10-year fixed rate debt with IO, typically the whole hold period, at leverages that are in the 50 to 55% range.
Mm-hmm.
So that allows you usually to make it through any kind of blips that we've seen. And we've been through 3 or 4 different cycles now over the last 30 plus years. So really structuring the deals to protect against the downside is more important than the upside to us. And that's how we've protected capital for this long. So we are sticking to our original plan, which is that long-term fixed rate financing, focusing on the locations, focusing on the operations of the property. One thing that slightly has changed is that we have seen newer properties being sold at discounts to replacement cost, some of the biggest discounts to replacement cost we've ever seen. And also these newer properties have been sold at prices similar to some of the older properties. So we've been gravitating towards buying newer, nicer properties and doing a little bit less value add than we typically have. So that's one kind of trend that we've seen. And the deals that we have under contract are all within the last 5 to 7 years, new construction.
Wow. I'm assuming a lot of those probably are, not necessarily obviously distressed assets per se, but distressed opportunities, maybe debt maturities or maybe just forced liquidity events. I mean, because I kind of look at it from a standpoint of we're much more long-term holders like you guys, so we buy something, we have a very low loan to value across our entire portfolio. We typically go on at very low leverage points, and we really look to hold things for 10 or more years. And so we don't have any, floating rate debt, mostly it's agency debt, Fannie or Freddie, maybe some CMBS, kind of sprinkled in there. But generally speaking, there's not too much that could ultimately put us in position to make a sell anytime in the next couple of years. Whereas I feel as though if you're selling in today's world, there's some type of emphasis that's happening behind the scenes to really not necessarily force, but push that sale. Because if you don't have to sell, you typically would just hold on and let the cycle ride out a little bit longer. Do you agree with that, or?
Yeah, no, definitely. It sounds like we have a lot of similarities too on the business side. But what we are seeing right now is we're kind of surprised that we have not seen more distress, more real kind of pressure for people to sell. But we are seeing, the only people that we're seeing sell now are funds that are coming to an end. So all the deals that we're buying now are either funds are coming to an end, either new construction deals where the debt is becoming due and it's going to be a cash in refinance. Some of these variable rate buyers too are selling at losses, but a lot of them are kind of extending and pretending and holding on. Yeah. So in our portfolio, I mentioned we have over 100 properties right now. We won't sell a single deal this year. We do not feel it's the right time to sell. We are not forced to sell. 8% of our properties have debt coming due over the next 16 months. On those deals, they were purchased 10 years ago. So if we do go to sell them, they'll still be good wins, good returns, obviously not as good as they would have been if they sold a couple of years ago, but still very positive returns. So we can either refinance those and extend them to a better day, either putting on a 3 or a 5 or 7 year loan, or even a variable rate loan just to hold it for a year or two. But we don't plan on selling anything right now. We don't think it's a good time. On the buy side, it's quite the opposite. We are really out there looking, very low transactions in the market. As you mentioned, we just got to find those people that are forced to sell. But we closed 850 million in acquisitions last year. It was 8 different deals. We closed 1 deal earlier this year. We have 4 deals that are under contract. So definitely staying very active, just trying to find anyone that feels a little bit of pressure to sell.
Yeah, no, fantastic. I appreciate that. Just on the operational side of the house, let's talk about, since you guys are vertically integrated with the property management side, just any changes that you've made. Again, just transactional volume has somewhat slowed for you on the front side. Still buying a lot of deals, but obviously transactional volumes down across the board. Have there been any? Now I feel like a lot of folks have had a lot more maybe time to just really hone in and perfect different aspects of their operational house. And so anything that you can speak to that maybe improvements you've made there, pivotal changes that have just improved the operations overall of the organization?
Yeah, always trying to improve, save on
Hmm.
expenses and run things a little bit better. Some of the things that really are kind of standing out to me from that question are first delinquency. So delinquencies
Hmm.
during COVID, they got pretty high as people weren't required to pay. But just starting even, it was 2 months ago, we finally got back to pre-COVID levels on delinquency. So really trying to clean up our delinquency. The court systems are now moving quicker. We have ability to evict non-payers in all markets. So cleaning up delinquency has been a big one. Doing some small improvements where, with the work from home movement and some technology improvements, the assistant manager position on site has not been as important. So we've been able to centralize the assistant manager position from the corporate office, have an assistant manager that can cover somewhere between 3 to 6 properties, depending on the size. That's been cleaning up a ton of efficiencies, really, really big cost savings. So just digging deep into where we can have operational improvements. And then on the resident experience side, really trying to retain our residents, have good amenities, good experiences for all of our residents. So there's been a lot of good improvements that have come out of this slower and transaction time, which allows us to focus on operations.
Hmm. No, that's I feel like we've been pretty far past COVID, generally speaking, but to hear that maybe you guys are just finally now getting to a pre-COVID level, that's it just brings back the challenging times that a lot of us faced in the property management business during that span,
Yeah,
and
and
some areas
and
harder than others. So,
And I think
uh,
that goes back to one of your points earlier about being in Florida. You might not have noticed it as much. I doubt you had the same restrictions that we had in California,
well,
where
we owned it a
we,
lot of other areas. So I
uh,
mean, we owned in New York during the very beginning stages of COVID. Not past the end of 2020, we finally sold out our holdings there. But anyway, yeah. So I definitely have a feel for what you dealt with. Maybe not on a grand scale that you did, but surely have a little bit of battle scars to speak to.
yeah, for sure. No, I mean, it's that's just one of those risks of that political risk over here. Just
That's right.
went for years and years of just challenges, but now we're finally coming out of it.
Yeah, well, fantastic. So, how about again, speaking on the operational side of the house? I know spending some time on your website. Seems like you guys are really heavy and put a big emphasis on just really profits are important, but really improving your profits by driving value for your residents. You guys have a lot of different charitable initiatives and green initiatives that you guys put forth. So maybe speak to that a little bit and just really how you've been able to intertwine and integrate that into the entire organization.
Yeah, no, and so yeah, we want to still have that good family feel, and the operations are very important to us, but so is
Mhm.
giving back to our family as well as our company. So every year we on the first of all on the employee side and on the team member side, now with over 900 team members, we want everyone to have a safe, secure place to work, and we really try to get to, and I do get to every property every year, which is a challenge now, but we want to make sure everyone's feeling how important their job is to us, and it does start on the front lines with the operations of the property. So that's been really important. They're one of our main stakeholders. On the giving back side, we usually pick a main initiative each year. And for the last couple of years, we've stuck with one that has really meant a lot to us. And it's the CASA program, Voices for Children, which helps with foster youth. So I've been working with many, many amazing groups on that. We try to bring in our team members, our residents, to help educate them and do different events to raise funds to support everything that they're doing. And then also working with homelessness too has been a big initiative. Just getting people that next start to get their life back on track. And in some of our markets, there's some major homelessness issues. So those have been some of the main initiatives that have been important to our company and our family.
And just I'm curious from another business owner's perspective. We all individually, it seems as though within the organization, find charitable endeavors very important. Each of us seemingly are involved or have been involved in different initiatives, but really looking to bring it more to a corporate scale and really roll it out within our organization. Literally just had a meeting last week with the number of consultants with our leadership team. Just really, this is one of the, one of like four big areas that we want to improve upon. And again, just look to integrate not just not just our staff and our employees, but also all the residents, the thousands of residents throughout our communities. And so just curious from again, one business owner to another, what that might look like internally. I mean, as far as, is there someone that kind of heads up that side of the house and kind of runs the charitable initiatives and then lets it trickle down from there? Or is that you? Or is that someone else?
Yeah, it starts from the top, but we do have a full-time philanthropy
Hmm.
um, team member that runs the philanthropy for the company and for the family, and really tries to make it enjoyable, educational, and impactful. So having different challenges between our North region and our South region on who can raise the most money and throw the best events for residents that are going to be the most successful. And there's
Hmm.
a cup that goes back every year, and it really helps to raise, over $100,000 a year for our Voices for Children, one of our main initiatives. And so we do have a full-time dedicated person that goes to this now. And that started a few years ago, and that made a major difference, because it's very important to everyone, as you mentioned, but
Hmm.
obviously with the busy business schedules, it's nice to have a little bit of additional help to organize and to keep everything moving.
Sure. What are you most excited about today, Jeff? What is that's such a loaded question, and I don't want to give direction on where to go with that, but just generally speaking about it, I guess, but more so from like a professional perspective, MG companies, just what excites you the most about where we're at today here as as we talk on May 28th of 2024.
Really, some of these opportunities that we're seeing are now some of the best that we feel that we've seen in a long time, in terms of the bases that we're purchasing at. So the
Hmm.
discount to replacement cost, the discount to peak pricing, very low transactions, as we've talked about, but really trying to find sellers and try to put ourselves in deals that are going to perform, that are going to outperform for the next 10 years. So with this big wave of supply that's coming this year and next year, it starts slowing down, as everyone knows, in about 2.5 to 3 years. And then with the way that development costs have gone, interest rates, there's going to be very, very little new development towards the end of the decade. And we're going to start to see that strong performance, just like we saw a couple years ago, starting in about 2015 in most of our markets. So
Hmm.
we're really having the opportunity now to pick and choose which opportunities we're buying, how we're going to position the portfolio going forward. Interest rates are a little higher than we would like, but they're still relatively very good. So, if you talk to Mark, my father, he would
Yeah.
say these interest rates are amazing. We're still getting sub 6%, 10-year money IO. But if you look at the last 10 years, they look a little bit high because we were getting sub 3% loans. But over the last 30, 40 years, they're still very, very good interest rates. So tons of opportunity on the buy side. And then as long as you're positioned well to hold through downturns and different situations in the market, performance is still actually very strong, and we're still seeing positive rent growth. We're still seeing good revenue growth.
Mhm.
Nothing like the last couple of years, but still very, very good performance.
Yeah. How about on the flip side of that note, I guess threats that you see, kind of biggest fears or biggest concerns over the next couple of years.
We touched on one of them a little bit. The political climate and
Mhm.
the some of the political risks of rent control and other issues in some of our markets have been a big risk to us. The interest rates going up, as fast as they did, and as much as they did in a short period of time, even though it didn't directly impact us as much, we saw a lot of just issues in the market, and it kind of raised a lot of questions with who was buying what deals, and what interest did they have in mind. And so just the interest rate unknown is always going to be a big
Mhm.
issue going forward. Even today, 10-year treasuries went up a little bit. I think we're above 4.5 now, which we were hoping not to see. But so the really on the political and on the interest rate risk, those are two of the biggest risks that we're seeing today.
And curious when you guys, it sounds like most of the time when you're looking at a new opportunity, you're going to underwrite it out to a 10-year projection. Is that an accurate statement? You might look at 3 and 5 years as well, but oh no, a
Seven to
10-year
10 is,
exit.
yeah,
Okay.
7 to 10 is going to be the most common for
And so
sure.
just curious because I know we're all doing the best that we can to make an educated guess, but like what does an exit cap rate look like on one of your most recent underwriting models?
Yeah, that's a great question. So I mean, interest rates on or sorry, cap rates on the West Coast got very low. I'm sure they got very low everywhere, but we were seeing, uh, sub 4 cap rates
Hmm.
everywhere. They've expanded about 100 basis points to 150 basis points, and so we are showing some small compression on the cap rate in our 7 to 10 year hold. So if we're going in at a 5.25 or a 5.5, we will either have an exit cap that's 10 to 20 basis points less than what we're going into for.
Hmm.
And we feel comfortable with that, knowing that cap rates were very low recently and that interest rates are most likely, in most people's opinion, including ours, going to go down and be lower in 7 to 10 years.
Yeah, no, that's a good one. I think we're running about 25 to 30 basis points 10 years out. So pretty similar in nature there. Again, it's all an educated guess, but I think it's a fairly conservative one that it sounds like your team and our team takes, not thinking that it's ever going to maybe look like what it did in 2020, 2021, 2022 as far as, 4 caps or sub 4 caps, which was pretty common as well down here in Florida, Texas real estate. I feel like it's kind of the same thing, at least when you speak to the multifamily space and the major markets such as Dallas and Houston and Tampa and Miami is just a different world entirely. Probably maybe even some sub 3 caps that existed back during the heyday. But in any event, just didn't feel like that was ever going to be sustainable. And now here we are, a number of years later, talking about some of the carnage that might be a result of that. So I guess lastly, before we work to wrap it up here, Jeff, just for those that are maybe, you guys have been at this again a very long time. You've learned a lot, you've seen a lot, you've been through a number of again of economic cycles. I mean, any words of wisdom or advice that you might give those that are tuning in that maybe they've got a couple hundred or a few thousand units, maybe they just got their start a few years back, what have you, but just they don't have the breadth of expertise that you and your group has, but just any words of advice or wisdom that you might be willing to share.
Yeah, no, that's a great question. And so many, there's a lot of volatility in the market now and a lot of variables. We do get this question, from a lot of our partners and new partners that we're talking to. And really, a few things that would be words of wisdom are, we really believe that the vertical integration has been key to our success, allowing us to pivot, control anything that happens at our property. So we love to see that in businesses. The track record's so important, getting through cycles and working through hard times. I mean, this last 10 to 12 years was an unbelievable expansion cycle, and
Mhm.
it made it a lot easier for people. And then also, looking at, the fees and the GP co-invest is really important too for investors as well. We always try to invest a significant amount of our own capital in each deal. It really changes the way you look at a deal and underwrite
Mhm.
it and run it. So, us typically never have less than 10% of the equity of any deal. And I think that's something that's really important for companies as well as investors.
I mean, to that point there, I mean, simply put your money where your mouth is, right? I mean, if it's that great of a deal and you're trying to get the excitement built around it, then again, nothing speaks higher volumes than that of you putting your own hard-earned money into the deal itself alongside with the investor. So I wholeheartedly believe in that sentiment. So in fact, even backing up a little bit, I think it's even equally more important if you're just getting started, if you're kind of tuning in here and just getting started is, um, you know, work to risk your own capital. If you're doing your first deal, your second deal, you risk your own capital before you risk that of others. Prove your concept and put your again money where your mouth is, and take the brunt of the risk on yourself before bringing others into the equation. So again, I know it doesn't always go that way. There's not always the opportunity to maybe you don't have all the capital yourself to do a deal, but again, just I think creating that alignment of interest is the utmost important. And that alignment of interest should never go away. So, Jeff, with that, Appreciate you coming on here today. For those that want to learn more about you and the company and just maybe touch base or stay in touch with you, where's the best place to learn more, to get more information? Maybe prospective investors. Is there anywhere? Is it the website, LinkedIn, other social links? Where's the best place to find you?
Yeah, website mgproperties.com, or feel free to reach out to me directly. We have a team as well that I can connect you with on any topics, and we are more than happy to share any insights or help in any way. And really appreciate you including me today, and it was great spending time together.
Yeah, Jeff, appreciate you coming here today and sharing your insights. And folks, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.